G'day, guys. Thanks very much for joining us for another market update with Catapult Wealth. Today we have Sam Twidale. He is a equity analyst at Citibank, PricewaterhouseCoopers. Lots of experience in London, and he is the portfolio manager of the DNR Australian Emerging Companies Fund. So that fund has done gangbusters, mate. Good work.
Thank you.
Yeah, excellent.
Plenty of volatility in the small cap space, so lots of opportunities have come up for us to take advantage of.
Yeah, right. And it's been a stock pick as well, right? So, being active has certainly paid out for some people.
Yeah, definitely. I think what we've seen is definitely a lot of dispersion in the market in terms of dispersion in quality across the small cap universe, huge dispersion in valuation as well. And I think for bottom up active managers willing to take a sort of a concentrated approach, it's really thrown up a lot of opportunities for us.
Yeah. Sam, look, we've got basically war in Europe. Looks like Ukraine will eventually fall, or at least a puppet government to be installed. That's blown up resource prices. Energy prices are going up in a world where inflation was already high. Talking about stagflation now, so inflation's going up, but the rising costs and war is going to basically reduce growth. And if we go down that path, well, it's a scary, like Japan-like environment, right? Given that, what's your predictions on what's going to happen in Europe and on what's going to happen in terms of the wider markets?
Yeah, look, there's a lot to sort of talk through here, quite a few issues going on. I think obviously a lot of uncertainty in the market at the moment, and we're seeing that sort of come through, a lot of volatility in share prices. I think what Russia and Ukraine is really doing is sort of compounding some issues that were already sort of simmering under the surface leading into this. And I think certainly you touched on what's happening with commodity prices and obviously the mining space. It's certainly we're seeing quite a run up in commodity prices. I mean, this is a sector we've been positive on. It's our largest overweight in our emerging companies fund. Resources and energy has been for the last 12 months, and I think it's we see a very positive outlook for the mining stocks and for commodities. I think on the demand side, we're definitely seeing very strong demand growth coming through for commodities. Being driven by some of these key thematics, like the transition towards renewables, energy, the transition away from the combustion engine towards the electric vehicle. That's incredibly positive for some of the base metals, lithium, nickel, copper, and rare earths. And I think in the small cap space, there's some great exposure you can get to that trend. But on the supply side, supply is very tight, and I think Russia and Ukraine's obviously a terrible situation. What's happening there, and it's really tightening up the commodity markets even further. I think leading into this, supply was tight because the mining companies have come off. The last super cycle 10 years ago, there's been 10 years of underinvestment. Mining companies, the big companies like Rio Tinto and BHP, they were very scarred from the last cycle. They've been prioritizing dividends, buybacks. They're the big dividend payers on the ASX now. They haven't really been investing in a lot of new supply. And obviously, some of the challenges around ESG means that it's more, it's harder to bring on new supply.
Yep.
So then Russia and Ukraine's come along, and Russia is obviously a key producer of commodities. A number of commodities like thermal coal, gas, oil, nickel, wheat, agriculture, and it's really sort of feeding through, tightening these markets even further. Europe is sort of showing that that the reliance on Russia for about 40% of its energy is showing to be a key risk for Europe. So I think what you're likely to see going forward, obviously in a commodity bull market, it's really positive for some of the high quality producers, but this whole sort of shift away from Russia, reducing your reliance on Russia, I think that this is a real pivot that's going to go on for a number of years now. I think there's going to be more shifting away towards Australia. I think Australia is actually really well placed to take advantage of this trend as a reliable supplier for commodities, for gas, traditional fossil fuels, but also these newer commodities exposed to some of these key trends like decarbonisation as well. So it's sort of tightening up or already tight market. But I think for the commodity producers, these are the standout valuation opportunities in the market. They're generating very strong cash flow, they're net cash. And it sort of feeds into the broader sort of trend we're seeing in the market. This sort of rotation out of growth. There's really expensive growth stocks that got bid up to very high valuations over the last 12 months in an environment of deflation. These companies got very expensive, very optimistic earnings assumptions as well. And now we're seeing a shift into these cheaper resources and energy, which have the double benefit of low valuations, but also earnings upgrades coming through. So there's a lot happening under the surface. The index is down a bit this year, but under the surface, we've got growth stocks, some are down 50%, commodities, energy, some up 50%. So there's plenty to sort of sink your teeth into.
Yeah, and it comes down to a bit of a, the low inflation environment was good for growth at the time, and now we're seeing resources which typically can be a bit of a hedge against inflation. With that, what do you think is going to happen with interest rates? Because the US was pricing in 7 rate hikes. That's obviously pulled back. What are your expectations around that?
Yeah, look, I think central banks have a very, very delicate balancing act here. I wouldn't want to be in Jerome Powell's shoes right now. On the one hand, we are transitioning from a deflationary environment to an inflationary environment. And I think there's lots of discussion around: is this inflation? Is this transitory? Is it becoming more embedded? We think there are definitely signs of it becoming more embedded. I mean, some of these supply side challenges are not going to be resolved quickly. I mean,
Yes.
it takes a number of years to expand production again of energy, of oil. It's feeding through into electricity prices, fuel prices, agricultural prices. We've got wage constraints. So there's definitely some building inflationary pressure. I mean, all the companies we talk to are talking about inflationary pressure. So that suggests that central banks have I think, overstimulated. They need to increase interest rates back to a more normal level and wind back the balance sheets as well. But the challenge that they face, though, is that we are in an environment of sort of stagflationary, of stagflation, where we've got increasing inflation due to supply side challenges, potentially some weakening of growth, and our central banks are going to then tighten into a slowdown to address this inflationary pressure. So I think some of these expectations for interest rate rises are sort of being pared back a bit, given the Russia-Ukraine conflict. But there's still a lot of uncertainty out there, and I think that's why it's still important to have balance in portfolios, making sure you're in good quality businesses. But overall, I think preparing portfolios for higher inflation going forward, and that does have significant implications for portfolio positioning. The kinds of companies that have done well in a deflationary environment aren't necessarily the same ones that are going to do well in an inflationary environment. So we're seeing a change in market leadership. The previous winners are not going to be the same winners going forward. And that's certainly what we've been looking at over the last 12 months in the portfolios, sort of positioning for this regime change.
Yeah, and this has all coincided with a sell-off of some of the COVID winners, right?
Yes.
Yeah, so it's a lot happening all at once, and very hard to predict, right? And so it's not surprising central banks don't know which way to go.
Yeah. Look, it's interesting. Some of these COVID winners, there's been some big beneficiaries of COVID over the last couple of years. Some of these online companies, software, companies exposed to this big boost in durable goods sales that we're seeing. But that's now coming off. We're seeing mean reversion back down, and it's sort of some of the services exposure that's really seeing the mean reversion back up, and that's where we've sort of reduced down our exposure to durables goods and increasing exposure to services, which have a lot of sort of pent up demand and sort of recovery potential. I think over the coming years.
Okay, so last question. We've seen the rotation; it's already happening before our eyes. From here, we've already seen copper and nickel explode. Where to? What areas are you liking now?
Look, I think there's definitely going to be ongoing volatility in the market. That's going to be opportunities for us to pick up good businesses which are getting indiscriminately sold off in this sell-off, and that's certainly what we've been looking to add. We're still cautious on some of the loss-making tech. These companies that got bid up to very high valuations, we think it's too early to go into those. I think there's still more downside potential there. Risk appetite for these types of companies are sort of drying up. They need investor appetite to keep funding their business models if they're not generating profits. You've seen cost inflation coming through, so profits are getting squeezed. So we're still cautious on that. We like some of these companies like Lavisa, fast fashion accessories retailer, one of the highlights of the reporting season. Very strong pent-up demands for sort of in-person activity.
Cheap jewelry.
Yeah, that's what they benefit from. IDP Education, leading provider of student placement services for the education sector, English language testing, an absolute global leader listed in Australia, international business. And we like some of these defensive business, like obscure companies that people haven't really heard of. IPH, intellectual property holdings company, an absolute cash machine, just generates enormous cash flow, which it's used to consolidate up the market in Australia, pays an attractive yield. And then otherwise, we still like the commodities and the mining energy space. I think these are.
So you think they've got legs even from here?
Yeah, I think that they are the standout valuation opportunity in the market. I think they're generating very strong cash flow. They are they've got strong balance sheets, and I think the structural outlook for commodities is the most positive we've seen for some time. I mean, we've basically come off a 10-year bear market, and we're sort of 1 year into recovery. And these sort of recoveries don't take some time. They take some time to play out. For when sort of high prices incentivize more production, that brings supply back into the market and corrects them. We're still some time away from that. So the outlook for materials and energy still looks very positive, and that remains a core overweight, and we're sort of adding any weakness there.
So going from a period of wild-eyed speculation, a bit like the tech boom, right?
Yeah.
We're now coming back to fundamentals, and conclusion is it's the macro is so unpredictable, right? What's Putin going to do? But it just comes down to stock picking valuations, and the metrics are important, and always just keep your head, on the ground, and keep your, just be careful what you're doing.
Yeah, that's right. I think it is back to bottom-up fundamentals. I think there's been a lot of speculation in the market over the last couple of years in certain pockets of the market, and it is I think back to good old-fashioned investing, bottom-up fundamentals, understanding the quality of the business and the degree to which it's mispriced, making sure that you've got that valuation grounding in the opportunities you're looking at.
Easy. Thank you very much for joining us, guys, and Sam, thank you much for your time.